Welcome to the Quarterly Economic Lens, where we unpack global and local trends shaping politics, markets, and investment decisions. We are witnessing a landscape marked by shifting power dynamics, diverging inflation, and a cautious sense of optimism. From policy changes in the United States and fiscal challenges in Europe, to China's efforts to combat deflation and South Africa's ongoing reforms. We will explore how these developments are influencing growth, stability, and investor confidence. I'm Tshiamo Masike, economist at Momentum Investments, and with me is our chief economist, Sanisha Packirisamy, to help us make sense of it all. Let us start on the global front like we always do, Sanisha. The global economy has been surprisingly resilient in the first half of the year, despite a turbulent backdrop. Global growth estimates have been revised higher. Bloomberg's median consensus now sits at 2.9% for 2025, up from 2.6% in April. Unemployment in major economies remains low, and we have so far avoided the recession that was widely anticipated. What are the factors contributing to this resilience?
Well, thank you, Tshiamo. So I think at the beginning of the year, we all started cottoning on to what kind of policies were going to come out of the US administration regarding protectionism and tariffs. But the big unknown, of course, was how the other countries were going to respond. Were they going to come with retaliatory policies? Were we going to see other trade arrangements being made outside of the US? And I think given that we have seen a number of trade deals forming outside of America, this has contributed more positively to growth in the first half of the year. We saw an element of front loading of imports for US corporates, and this was really to avoid the tariffs that were pending. And that, of course, gave quite a big boost to your inventory levels. And higher inventories also contribute more positively to economic activity. And then quite a positive development relative to the pandemic, and this was around a rerouting of supply chains. Now, if you think back to COVID-19, the pandemic, China was on an extended lockdown. Companies got quite nervous about how they were going to get the raw material inputs from Asia that they needed for their own manufacturing processes. This time around, we've seen that corporates have learned hard lessons and have now started to reroute some of these supply chains. So products came through a lot quicker, and that also contributed to the outcome of GDP for the first half of the year. Ultimately, we also saw that fiscally and with monetary policy, there was also additional support lent to economic activity. So we saw governments around the world spending more from the fiscal side, particularly on your infrastructure, but also military and defense systems. And then we also saw that central banks continued to cut interest rate policy. That, of course, lowers the rate of borrowing for consumers and businesses. And so that adds to economic activity. And then last but not least, I would also put in there the boom that we saw from artificial intelligence or technology. So quite a lot of data centers being built around the world. So that contributes to fixed investment spend. But the nice output from there is higher levels of productivity. So encapsulating all of this, I think there was quite a bit that we didn't really know was going to contribute quite positively to the first half of the year.
Those are indeed a lot of factors that have supported the economy. But has the resilience witnessed in the first half of the year now carried through to the second half of the year, or are we starting to see some risks creeping in?
So I would say that there is some complacency that is setting into financial markets, given that we had this robust economic activity in the first half of the year. And one way that we can see this is through the Bank of America survey for global fund managers, where they ask them, what do they think is going to happen in the next year? Is there going to be a hard landing in the economy? In other words, like a recession? Is there going to be a soft landing? So continued growth, but at a softer pace, more tempered? Or is there going to be no landing? In other words, the global economy just carries along at the same economic momentum. And I think what was quite surprising in the October results is that a third of global fund managers expect no landing.
Okay.
And so given that, the front loading of those imports is now largely in the base, and we also have to take account of the economic delays from the shutdown in the US economy, there will be an impact coming through for economic growth that I don't think is fully being encapsulated by market expectations. There's also an issue around when tariffs actually impact businesses in America. And so for this point in time, they're not really fully experiencing the full tariff rate because of those inventory discrepancies when they import the goods, when the tariffs are actually allocated. And so the full impact of tariffs is yet to actually hit the US economy and spending on that side of things. In addition to that, if you remember the first half of the year, we had a positive surprise when the trade issues actually de-escalated between the US and China. And now going into the fourth quarter of the year, they've picked up again with the US administration promising to increase tariffs even further on Chinese imported goods. And we also know that Donald Trump has also threatened to put an additional tariff on India as a penalty for importing cheap Russian oil. So again, we've got, more turbulence around the tariff policy coming through quite strongly. And then across the Atlantic, we also have some issues in Europe, which could dampen growth the second half of the year. In particular, I'm thinking about the policies that we've seen coming out of the French economy. We now have the fifth prime minister under Macron's second term. Macron is the French president, Emmanuel Macron. They have quite a turbulent situation around the debt dynamics, and there's no clear answer as to how they're going to rein in that fiscal deficit. And remember, what's happening in France is just one item within the entire European region that is showcasing a big rise in populist policies and populist support, which can be quite damaging for socioeconomic implications. And I think altogether, this does paint a picture of slowing momentum in economic activity for the second half of the year.
I think another development that came up was the US government shutdown. So while government shutdowns have not typically affected equity markets historically, they do add a layer of uncertainty and raise political and economic stakes. We also know that it's not uncommon for lawmakers to easily unite on budget measures, and we have seen extensive shutdowns in the past. Can you walk us through what triggered the 2025 shutdown and why does it actually matter for the economy?
Well, at the crux of it, the main issue was essentially the extension of the health and medical tax credits. Now, this matters a lot for those that are buying medical insurance in the marketplace. And if these tax credits are not extended, it does mean that medical inflation will then pick up between 4 and 8% over the next 2 years per annum. And so that can have quite a big implication for consumers' pockets. Now, we know that shutdowns, because they're not really all that uncommon, they don't typically affect equity markets, but they do affect the real economy because policy uncertainty tends to spike, and we also see some dampening impact on consumer sentiment. Now, if we go back to the back end of 2018, we had one of the longest shutdowns, almost 35 days. And during that period, we saw that consumer sentiment drop to its lowest level in more than 6 years. And so if I look at consumer sentiment as we stand today, it's about 5 percentage points above its all-time low. So consumer sentiment in America quite depressed. And so that means that any other negative news could actually tip over that negative spending, negative sentiment, actually dragging down GDP growth. And what worries me right now is that the Bloomberg median consensus for the fourth quarter growth number in the US is still sitting quite high at 1.2%. And I'm not quite sure if that consensus is fully factoring in some of these downside risk factors that have crept in. And of course, a lot of this downside risk from the shutdown comes through from workers being furloughed. And that means that they don't really get paid while they're not operating in office. And they only get that back pay once they come back. And so there's quite a big chunk of purchasing power that's actually pulled away from economic activity for the fourth quarter number.
On a positive note, though, we have seen efforts by President Donald Trump's administration to broker a peace deal between Russia and Ukraine. And more recently, he was successful in securing a ceasefire deal between Israel and Gaza just before the second anniversary of the conflict. How significant is this development? And could it ease some of the central bank demand for gold that's been partly driven by geopolitical risks? We've seen gold prices recently break above the 4,000 US dollar mark, and foreign central banks now hold more gold than US treasuries for the first time since 1996.
Okay, well, Tshiamo, you touch on the issue of Russia. And
Yeah.
so, if we look at the president in Russia, Vladimir Putin, he hasn't been that excited to get to the negotiation table in terms of brokering a peace deal with Ukraine. And I think that's because Putin wants one last crack at that line of defense. And I think when it becomes quite apparent that Russia's not going to be able to annex more land in Ukraine, that's when the situation starts to look like they may not win more of the war. I think that's going to push them towards the negotiation table. And then we can see some sort of peace agreement being put into place. I think that economic pressures are starting to pick up quite considerably for Russia. We've already seen quite a steep drop in their revenues from fossil fuel sales. Now, we know that they found alternative markets outside of Europe. They send a lot of their stuff to emerging markets, including India. But of course, that has come with a price drop. So the overall revenue in rubles has actually come down. And so there is a lot more economic and fiscal pressure for Russia, meaning that they do need to get to that negotiation table at some point. If we think about the peace deal that's been brokered in Gaza, I do believe that's going to reduce that immediate geopolitical risk. But if you want to have a longer peace process in place, it means that all the action items on that peace deal need to be adhered to. There can't be any ifs and buts coming through from Hamas or any other parties that are conditional to this agreement actually fulfilling a peace agreement in the region. And so while I think for now we could get a bit of a lull in geopolitical activity, this has always been a hotbed for geopolitical risk, the Middle East in general, because of these long-standing ideological issues. And I think this could potentially come up again in future, especially if this plan is not adhered to very strictly. Now you ask about, the demand for gold, and I do believe there's a structural underpin for central bank demand for gold. We've seen quite a sharp pickup in the gold price, which means that we maybe see a tactical pullback, but I think there is a structural force underpinning demand there coming from central banks because they are largely price insensitive at these levels. They want to buy gold because of geopolitical risk, and emerging markets still have quite a long way to go before they get to those average world levels of FX reserves.
So continued support for gold is not completely off the cards. I think maybe turning to Asia, China has been grappling with deflationary pressures. How is the government there responding to this? And more broadly, what can we expect in terms of global inflation and the direction of interest rates?
Well, China has a couple of things in their toolbox to make the economy pump again. The one is on fiscal stimulus, and they have been issuing a number of special infrastructure bonds. So that pushes up your fixed investment angle, and that contributes to economic activity. And then on the monetary policy front, they still have a bit of room to actually cut lending rates to spur borrowing for consumers and for businesses. Now, in China, we've seen over the last 2.5 years or so that pipeline pressures on inflation have actually been in negative territory. So we have deflation from a pipeline measure perspective in China. And as a result, we've seen that China has exported this deflation to the rest of the world. So while they aren't actually exporting as much to the US, they have found other markets like Africa. And this has caused quite a big divergence in inflation outcomes in the world. So the rest of the world experiencing tariffs like a demand shock. So that's been disinflationary, positive inflation, but falling inflation. And for the US economy, it's actually been a supply shock because that's the economy that's actually imposing the tariff on other countries around the world. And so that's actually been pushing up price pressures in the US market. Now, even though the US is likely to see inflation picking up over the next couple of months or so, the market still believes that interest rate cuts are forthcoming in the US. So if I look at Fed futures, they are pricing in up to 4 interest rate cuts by the end of 2026. But with that inflation divergence in the world, that has now led to a monetary policy divergence in the world. So while the US is expected to cut by 4 times, the ECB is probably going to stay on put levels until we get to the end of next year. If we look at the Bank of England, they are still contending with high levels of inflation, particularly on the wage front. And so even if we do get interest rate cuts there, it's probably going to be a second half of 2026 story.
Okay, so turning to South Africa and picking up on that interest rate theme, the South African Reserve Bank recently announced that its preferred inflation level is now 3%, down from 4.5% previously. Markets have viewed this favorably, and once formally announced by the finance minister, it will yield some benefits such as lowering borrowing costs for government, businesses, and consumers, while also supporting purchasing power. What are the risks for the inflation and interest rate path?
So, even though all the stars have aligned for inflation in South Africa, I still think there are some key upside threats. The one is coming from the electricity tariff. We know that the energy regulator, NERSA, made a small little error of 54 billion Rand on Eskom's revenue calculation. And so that means that consumers are probably going to face an increase in their electricity tariff of between 8 and 9%, not only for next year, but the year after that as well. And so that's quite a long way off from where they want to target inflation in SA. And on top of that, medical aid inflation, which is your second biggest component of services inflation, the first being rental inflation. Here, looking at the medical aids out there, I mean, including some of our competitors from a health business perspective, it looks as though those tariffs are going to come somewhere between 7.5% and 9.5%.
Quite high.
So it's quite high and quite a bit above, the rate of inflation that they want to target. And so we see those as key upside threats. Now, fortunately for us, the Rand, despite all the geopolitical turmoil and the local political upheaval, has actually been quite contained. And so we've seen quite a well-behaved currency domestically, partly because of a weaker dollar since the start of the year, partly because of this risk-on sentiment in global markets, but also because of a positive terms of trade. So in other words, the stuff that we export to the world, such as gold and platinum, have gone up in price by 55% for gold, almost 80% for platinum, whereas the stuff that we import, like oil, has come down. So the price of oil since the start of the year down 15%. And so that has contributed to a favorable terms of trade and favorable Rand outcomes for South Africa. And we have also seen that inflation expectations have been trending lower. So analysts believe when the Reserve Bank says that they are going to target 3%, and those expectations have now adjusted lower. So for us to eventually get to that 3% target and make it easier for the finance minister to make that decision, I do think we need to be able to see fiscal prudence in order for it to be successful and for inflation expectations to head lower. I think if all those stars align, then we could potentially get more cuts in interest rate policy, potentially one in 2026 of 25 basis points and another in 2027.
That would be good for the consumer. So earlier on, we spoke about how other countries are trying to shield themselves from trade tariffs and these shifting power dynamics. With the African Growth and Opportunity Acts, popularly known as AGOA, having expired on the 30th of September this year, there is uncertainty over its renewal, and this has heightened concerns about South Africa's trade relations with the United States. How are trade talks with the United States evolving now?
Well, we started off on a bit of a rocky front, but it looks as though the framework deal is developing as South Africa has made some concessions and tried to meet the US on middle ground with things like importing poultry and blueberries and liquefied natural gas and committing for South African firms to invest more in the US. But outside of the trade issues, I think for us to truly repair relations with the US, we also need to address a number of policy issues. And there are three that come to mind. So the first is around including null compensation as a line item in the expropriation bill. The second is we need to become, really push having an ambassador to the US. And I don't think we've made enough strides in that regard. And we need to have this being someone that the US can take quite seriously in trade and investment relations with South Africa. Thirdly, I think, South Africa has been blamed for taxing capital on arrival. And this has been through the BEE policies and regulations that has been quite a dampener for foreign capital. Now, outside of the US, because they account for less than 8% of our exports, South Africa has been trying to deepen trade ties with other Asian markets, Middle Eastern partners, even other African nations. But I think a lot more needs to be done for South Africa to increase its exports to the rest of the world. So as an example, we need to make sure that we have enough foreign trade representation across the world to showcase South Africa. We need to have more trade fairs to show where South Africa can be competitive in this export landscape. And lastly, we need to align with global standards. Other countries are embarking on processes of digitizing customs and having tracing requirements. And so if we go that route, it will make it much easier for South Africa to get our products into other countries.
Talks of trade diversification are encouraging, especially given our weak economic growth. SA's economic growth did surprise on the upside in the second quarter of 2025, but both consumer and business sentiment weakened in the third quarter. The government of national unity has provided a degree of stability, but optimism has faded. And we have the next round of local government elections coming up between November 2026 and January 2027. The elections are a while away, but we are already starting to see some political activity pick up. How might sentiment on the ground shape the election outcomes, especially given the rise in service delivery protests and growing concerns around the security cluster being unpacked in the Madlanga Commission?
Well, a lot of what you mentioned here really impacts the consumer negatively in terms of sentiment. And if we talk about service delivery protests, these are actually monitored by Municipal IQ, and we've got data for the first half of the year. But if we had to say that the same number occurs in the second half, this year could be the highest on record in terms of the number of service delivery protests, and that really talks to ANC failures in a number of metros. Now, if we think back to the 2021 local government elections, the ANC might actually struggle to retain support in some of the key metros. Their margin of victory in Tshwane, City of Johannesburg, Ekurhuleni was extremely thin back then, and so you only need a little bit of a shift in order for the ANC to lose that power base. And I think what adds to the complexity of the local politics in South Africa here is the fact that Democratic Alliance Helen Zille is now going to be running for the mayoral position in Johannesburg, and that could alter the dynamics for Gauteng as a province. And that, of course, can then lead to a lot of complexity come time of the 2029 national elections, where the balance of power can be significantly altered, and we could potentially see coalitions in quite a different shape or form.
So let's turn to the network system. Kusile Unit 6 came online, and Kusile is now fully operational after 17 years since the investment decision and at a final cost of roughly 161 billion. This is almost double the original estimate. Nevertheless, Kusile and Medupi power stations combined now deliver up to 9,600 megawatts when they are fully operational. Furthermore, the number of unplanned shutdowns has also come down, and this signals tangible progress on the ground. Beyond that, we've seen steady progress on momentum, particularly across the three sectors that make up 80% of our infrastructure, and that is energy, logistics, and water. And I think this continues to anchor our positive outlook for economic growth in the medium to long term. Can you give us a sense of what's been achieved on the reform front, especially relating to these three sectors over the past quarter?
Well, maybe let's start with energy. We know that there has been a lot of interest in renewable energy from the private sector, to the extent that we actually ran out of transmission grid in 5 of our provinces. And so now government is making additional steps to ensure that we have enough transmission network, and we will be soon entering phase 1 where the actual investment will start hitting the ground. And that also involves a lot of foreign interest in terms of the funding for that. If we look at the water space, in August, a number of legislative pieces went into Parliament to try and split the water service providers out of the water service authorities. And what that does is that it then enables the private sector to begin to play in that space to become providers of water. And we can actually increase security of water supply and sanitation services there. We've also seen a ring fencing of revenues at certain municipalities on the local government side. So that means that the water and electricity revenue that they receive then gets reticulated into infrastructure for water and for electricity, so that we don't have the situation in Joburg where more than 45% of the water is lost through leakages. And then finally, in the logistics sector, we've seen that 11 private freight operators have now been granted conditional access to more than 40 of the railway corridors in South Africa. So that would include sugar lines, manganese, ferrochrome, coal, etc. And ultimately, what that does is create a far more competitive landscape in logistics, which can help to lower prices in future.
It's indeed positive that South Africa's reform momentum is moving in the right direction, even if slow at times. Of course, the path ahead won't be without challenges, from subdued growth and political uncertainty locally to global headwinds like trade tensions and policy shifts in major economies. It is a complex environment, but one that still offers opportunities for resilience and renewal if momentum is maintained. Thank you.